Hello and welcome to Choose FI. Today on the show, we have my friend Jesse Cramer. He is the founder of the Best Interest blog and podcast, of which I was a guest last year and just really enjoyed going on his show, getting to know him. His energy is fantastic. I think you're really going to like him. He's a former engineer and he now works with clients as a financial planner at a fiduciary fee-only wealth management firm in Rochester, New York. And their mission is simple: to guide people to a successful financial future. And Jesse reached out to me a couple of weeks ago and said, "Hey, I was perusing the Choose FI Facebook group and I see all these kind of 101 level questions like, hey, I have $5,000. Should I put it in Roth or a brokerage?" Or people answering like very specifically with, "Oh, Roth, put it in VTLCX, et cetera." And he said, "I don't know how people can give such confident answers without understanding the Rudy Lou investing framework." And so it's an acronym, RRTTLLU. We're going to call it Rudy Lou going forward. So he said, "I don't understand how they can be so confident without understanding this investing framework." And it sounded so fascinating to me that I knew we had to do an episode on it because it is this significant framework of risk, reward, taxes, timeline, liquidity, legal, and unique. And I think you're really going to enjoy this episode. With that, welcome to Choose FI. Jesse, thanks so much for joining me. I'm excited to have you here.
Brad, it is an honor to be here on Choose FI. Thanks so much for having me.
Yeah, you bet. You bet. I always love talking about new things. And I think we're really trying to, it's always been a podcast about taking action and actionable advice. And I think this is a cool one because I think you're right. I think your kind of very subtle critique, and I don't think you necessarily meant it as like this hard biting critique, but subtle critique of, hey, look, there's not just one simple investing strategy or advice for everyone as a blanket thing, right? There are other considerations. And I think that's where this very interesting Rudy Lou acronym comes in. And I'm excited to dive into it.
Well, thanks, Brad. And you're exactly right. I mean, for what it's worth, and for listeners out there, I was a DIYer. I still consider myself a DIYer. If I wasn't working as a planner, if I was still working as an engineer, I would be doing all this stuff DIY, making my own investing decisions, making my own financial plan. So I love the fact that there are communities out there like Choose FI, that there are Facebook groups and Reddit groups where people can feel comfortable enough to write in. And kind of the classic one that sticks in my mind, a couple names or changes, my name's Sharon, I'm 48 years old, I work as a nurse, I'm way behind the curve on my personal finances. It's like, so far, Brad, and we've seen that story a lot.
Millions of times.
Exactly. And then Sharon says, I'm starting to contribute to my 403b and I opened a Roth IRA and I'm not sure how to invest. And just about every time that question comes up, which on Choose FI Facebook group is like a weekly basis, right? All the time you see questions like that. And we've all seen answers that will come in one word answer: VTSAX, S&P 500, stocks, index funds. And most likely those answers actually probably are directionally right. Like those are probably the right answers, but they're all premature answers. We have no idea, based on what Sharon has provided us in her very kind of short statement, we don't really know if those are right answers yet. And so just like you said, Brad, I'm not trying to critique too harshly, but I think there are some ways that we can go deeper. And this Rudy Lou framework, which is a very goofy sounding name, I grant you, but what belies or what lies underneath the Rudy Lou framework is very helpful. And I think everyone would benefit if they start thinking along these terms a little bit more.
Yeah, I like this. I think anytime we can add a layer of nuance that doesn't overwhelm with complexity, it only adds to the community and it only adds to our understanding, right? I think one of the potential harms when it comes to like financial experts is they often try to hide behind complexity.
Right.
And usually it's them selling some ridiculous thing that's fee laden that, oh, of course you regular people can't understand this. You don't have the training and you don't have the letters behind your name that I do, right? Like that's the kind of stuff we avoid at all costs. And I think both you and I would say for the vast majority of people in the total vacuum with zero information, low cost index funds or ETFs are going to be a great option. So I don't think in any way, shape, or form we're saying that that is not going to be the right answer ultimately for the vast majority of people. But I think your fundamental point here is there's nuance and
Yeah.
every situation is different. You cannot possibly understand just from a line or two in a Facebook post everything you need to know about that person's situation to answer the question. But most importantly, that person who's even asking the question probably doesn't even realize the layer of nuance that they have in their own life that they need to provide in order to maybe get the right answer.
Correct. That's exactly right. And there's a little bit of, if we're not careful, you can get a little bit of the blind leading the blind, or you can get, speaking of kind of blind metaphors, in the land of the blind, the one-eyed man is king. If you're not careful, that's what some of these online conversations become, where you're not quite sure of, who is this person who's giving me advice? And one of my favorite things, and happy to give this person a shout out because he's awesome. We all know it. Cody Garrett. When I see Cody chime in on Choose FI on the Facebook group, he will always answer one of these questions like, "Hi, Sharon, we need to know some more things about you. What's your timeline looking like? Is your goal retirement?" And Cody will be the one to ask deeper questions. And I think everybody can learn something from that. Going back a step, though, Brad, you're exactly right. I mean, the vast, vast majority of my long-term assets are in low-cost passive index funds, or very similar. The whole idea is low cost and passive. And the same goes for my clients. Like low-cost passive indexes are the way to build a terrific portfolio for yourself, no doubt about it. And so I think it's a terrific strategy for most people. And when we go through this Rudy Lu RRTTLLU framework, we'll start to see why that's the case. So we can start right at the top, right? Risk and return are the two R's at the beginning of the acronym. And whether we're looking at an investment itself or we're looking at the person who's thinking about investing, we need to ask ourselves, what are the risks associated with this investment? What's the risk tolerance of the person who's investing? What are the likely returns of the investment going to be? Or maybe what's the broad spectrum of potential returns that the investment might provide? And what kind of returns does the person need in order to achieve their goals? So there are all these questions that we should be asking in the R's of the acronym when it comes to risk and return, what the person needs, what the investment provides, and are those a good match?
Yeah, I think when you often hear, "Oh, what is your risk tolerance?" Like you'll get this question. You go to
Mm-hmm.
any financial professional or even your brokerage firm or something, and it's something that ultimately is lacking nuance from what I've seen. It's just, "Hey, I'm aggressive, I'm moderate, or I'm conservative." And like to me, that is one of those kind of questions that provides essentially no detail. And
Right.
I don't know, even I wouldn't know how to answer that essentially. How do you think about that particular question? And then how would you frame risk into something that can actually provide value?
Yeah, you hit the nail right on the head there, Brad. I mean, that question in and of itself is so hard for 95+% of people to answer. What's your risk tolerance? I don't know. Compared to what? Or I've never
Yeah.
had to think about it before. I don't know. So there are different ways you can go about it. One of my go tos is to simply ask people about their investing history. Maybe, for example, they've slowly put money into a 401k over time, and they've always been in a target date fund. And so they've lived through the bear market of 2022. They lived through COVID, the COVID crash. Maybe, depending on how old they are, they lived through the great financial crisis or the dot-com bubble. And so they lived through some periods where they saw their accounts decline by 20 or 30 or 40% over a 6 or 12 or 24-month period. And so I can ask these people and say, how did that make you feel? Did you lose sleep at night? Did you have physical symptoms from that anxiety over seeing your accounts go down? Or did you basically say, whatever, I don't care about it right now. It won't matter for decades anyway. Getting those kind of conversations going with people, at least to me, sheds a lot of light on an individual's risk tolerance. If they haven't lived through some of those scenarios, well, then it's more about posing the hypothetical along the same lines, meaning, you can say, listen, in the great financial crisis, many people lost 40 to 50% of their account values if they were majority stock owners. How would you feel if you saw your account go down by 40 or 50%? Granted, it recovered eventually, but in the moment, as you're living those days and weeks, your account was down a lot. And how would you feel about that? Some people know themselves well enough to give you very clear answers about how they would feel. Other people aren't quite as sure. So there's a little bit of a science and a little bit of an art. It really helps when someone has experience, if they know themselves well. But just the blanket question of what's your risk tolerance very rarely does good.
Yeah, it's so silly. I'm curious. So I know you work at a fee only financial planning firm. So I'm not sure if you guys, I guess, manage investments or not. But let's assume that you do, which you're shaking your head yes. So I think yes. Is there a way? I know obviously you can't, or I certainly don't believe that you can not basically accede to the client's wishes during like a major downturn or something. But is there any way to safeguard them from their own psychology? Because I think you can have the best intentions for your risk tolerance, but in the midst of a 30 to 50% drawdown amidst March 2020 esque type thing, like how do you, I guess, let's take that step back and say, how do you talk to your clients? When they called you in March of 2020, I'm not sure if you had left your engineering job at that point, but what do you say to them? How do you talk them through off that ledge, basically?
Yeah, no. So to answer the second part of your question, I made my career switch at the beginning of 2022. So at the very least, I had a lot of conversations in 2022 about the bear market that was going on then in both stocks and bonds. And then last year we had a couple, small corrections in the stock market that triggered a few conversations. I wasn't here. I wasn't working in this industry in 2020 though. But still, I think the answer to your real question, Brad, is the same, which in our case, it's a multifaceted answer, right? And so let's think about a client who maybe is approaching retirement and they're starting to put more and more of their assets into the bond side of their portfolio, which maybe not everyone listening to Choose FI agrees with. And I'm okay with that, but I'll explain to you the way that we think about it. So let's say I'm dealing with a 55-year-old who's 70% stocks and 30% bonds, just to keep it simple. And right, we had a bear market. The stock portion of their portfolio drops 20%, and they're really feeling that gut punch. The way that we build portfolios, or just think about portfolio construction from the ground up, is this idea of, and we're going to get into this with Rudy L, we think about the timeline of their investments. And for that person, for any assets that they need in the next 8 to 10 years, we want those assets to be in bonds. And the reason why is because even when you have a very diversified stock portfolio, you don't know for sure if stocks are going to give you any sort of positive return, let alone outperform bonds over 2 or 4 or 6 year timelines. Stocks are a decade plus investment. And that's why it's really important to understand an individual's timeline. So when the market crashes and maybe their stocks drop 20%, I'm able to sit down with a client and say, listen, the 30% of your portfolio that's in bonds, that's meant for your next 8 or 10 years of spending, that hasn't fluctuated at all. Hopefully. I mean, that's why we invest in stocks and bonds. They usually behave in different ways. Or if it has fluctuated, usually it's on a much smaller scale. And so we're able to say these assets over here are still in a very good spot. Yes, it stinks that your stock portion of your portfolio is down, but in the 8 or 10 years from which you'll be drawing down on the bond portfolio, that should be more than enough time for the stock portion to recover. So we're able to kind of half mathematically back our way into a position where we say your portfolio is still in a good spot. Another really good thing, Brad, and then I'll pause because I've been rambling on for a little bit, is education is so important here. Providing people with the understanding that 10% corrections in the stock market on average happen just about every year. A 20% bear market, there have been 14 of them since 1950. And we're each going to have a 30% drawdown once a decade. And maybe once or twice between now and the time we die, we're going to see another 40 or 50% drawdown. Knowing that going in, helping people understand that when they have a portfolio is very important. And it helps during those down times to bring that back up.
Yeah, I definitely hear you, Jesse. It's so important to understand that these drops are coming and they're coming with frequency, especially when you consider an investing lifetime of 30, 50, 60 plus years. They are coming. And I think, right, that's what we're spending a lot of time on risk, but I think it's really important because you have to understand there's actual risk and there's just the realities of life and investing and a lifetime that is a significant amount of time. Again, like I said, an investing lifetime could be 60 plus years. And you have to understand what's actual risk versus what is just a normal happenstance and the normal realities of the market. And I think that's really important. Another thing that I would suggest for people, again, because it's all about just taking action and understanding, okay, this is coming. We've talked about the investor policy statement before. So we had Jim Dolly from the White Coat Investor on years ago. And I think we did an episode, it looks like episode 189 on investor policy statement. I think this was Jonathan coming up with his own investor policy statement. And I think that's something that we all can do to kind of safeguard ourselves psychologically from, okay, when I'm clear thinking and life is good, I'm sitting down and writing this document for those times when the world is going to hell in a handbasket, right? And because whether it's that 50% drawdown that you said is going to happen once or twice in an investing lifetime, or just the normal 10%, which happens almost every year, if you have that policy statement set, I think it'll help with this risk level dramatically.
Totally. And as you're talking about the IPS, the investment policy statement, which is, I think there are a lot of places where that comes in handy, and it's used in the professional setting a lot for what it's worth. So a similar analogy that may or may not hit with listeners is, imagine if let's go back in time, and let's go back to when you're 18 years old and you're thinking about going to college, and it's coming down to two choices, and you love both schools and you're not sure which one. And for whatever reason, because this is my hypothetical and you're just going to have to follow along with me, you make your decision right after getting T-boned at an intersection, right? You get in a car crash and your adrenaline is pumping and you're scared and it's chaotic. And right then and there, you decide to make a decision on what you're going to do. Like, who would do that, right? It's just craziness. It's craziness.
Yeah.
And similarly, you don't want to find yourself having to make big investment choices after your portfolio has dropped by 30%. It's very similar. You would much rather make those decisions with a clear mind beforehand when everything is calm and rational. And then you have to have the follow through, though, to go back to that IPS after the fact and make sure you live it and you really put it into practice.
Agreed. And yeah, the absolute bottom of that horrible drawdown is not the time to be updating the policy statement, right? Like
Right.
you might find, oh, wow, I actually do need to update this, but you do it again when you're thinking clearly and emotion is not clouding you. So, one last thing that I wanted to talk about with risk before we move on is the risk of opportunity cost. I think this is something that is often overlooked, and people conflate risk and volatility when it comes to the market, and they don't think about the risk potentially of opportunity costs of not investing, but being quote unquote safe, right? But what they're really saying is they're worried about the volatility. I'd love for you to talk about opportunity costs and risk and volatility.
Totally, Brad. I think most listeners out there, or at least maybe they've been listening for a while, if they're relatively familiar with these topics that we're talking about, they will understand that over long periods of time, stocks outperform bonds. There's this term, stocks for the long run. I think Jeremy Siegel, who's a famous economist, investor, academic, talks about stocks for the long run, and it's incontrovertible. The reason being is that stocks present a level of risk that you could lose all your money if a company goes out of business, if the underlying company does. And investors demand a higher return for that. So this gets back to the whole, there's an intrinsic connection between risk and reward, risk and return in all investing. Whereas bonds, in a hypothetical scenario, Brad, where you and I are invested in a company, I'm an equity owner, so I own stock in the company, but you've just decided to lend the company some of your money. So essentially, you're a bond owner for that company. If the company were to go out of business, and they sell all their furniture, they sell all their assets, and you get this probably from your accounting days, maybe you had to run into this, you would know that in that capital structure, you as the bond owner, you get paid back first. And only if there's leftover money after that will I, as the equity owner, get anything back. So I'm taking on a lot more risk, because if something goes bad, you're going to get your money back. Maybe you only get 80 cents on the dollar, but if you get 80 cents on the dollar, that means I'm getting zero on the dollar. There's nothing left over for me. So stocks return more than bonds. Okay, we've established that fact. And as we're discussing here, when someone has part of their portfolio in cash or in bonds for the short term, they are certainly giving up something in the long run. And that's why it's just about finding that right balance. And for some people in the Choose FI community, for some people out there, if you're really young right now, there's a really good chance that 100% stocks might be the right allocation for you. If you have no need to pull on any of these assets in the next 5 or 8 or 10 years, okay, 100% stocks might be right for you. But if not, if you do need some of your assets in the nearer term, like, 3-5 years, like we've been talking about, and then depending on your comfort with owning a lot of stocks, and this is where it gets into the personal risk tolerance conversation again, you have to look yourself in the mirror and understand that you're giving something up by owning cash or bonds. That's the opportunity cost. And sure, it compounds a lot over time. But this is, I'm going to pull out a Warren Buffett. Warren Buffett's my favorite, all-time favorite by far.
Same,
Uh,
same.
and Warren says, why give up something that you have and you need for something that you don't have, but you don't need? And what he means there is, why take on extra risk to get more, to get more, to get more, when you're putting at risk the thing that you already have right now and that you very much need. And to put it into portfolio terms, I would say, let's say there's someone out there listening, they've got $3 million, they've hit their FI number, and they're debating, should I be 100% stocks or should I be 70% stocks, 30% bonds? They've already hit their FI number. And my answer would be, well, listen, either one of those portfolios, you're probably going to be fine. At the 100% stock level, you're definitely going to die with a bigger pot of money, no doubt about it. But you're also going to be more at risk of severe damage if there's some crazy event and some big drawdown. So you kind of have to ask yourself, why give up what you have and need for something that you don't have, that giant pot of gold? And you don't really need that giant pot of gold. So that is the opportunity cost conversation to me, is you're giving up upside, but you're also preventing some of the downside. And for each individual person, it's going to look a little bit different. Does that make sense? What do you think about that?
That makes perfect sense. And it's interesting how we've kind of been focusing on risk, but it's really morphed into a conversation about the first three letters, right? Risk, return, and timeline, because they
Yes.
all are inextricably linked here. And yeah, I guess what you're saying or what Mr. Buffett's saying is, if you've already won the game, do you really need to take outsized risk? And the answer to you might be, it could be yes. You might do your thing and stay 100% stocks, and that's fine. I don't think, obviously, it goes without saying, we are not giving financial advice on this podcast. What we are saying is, this is food for thought. These are things that you need to think about for your personal financial situation. And you also need to update that thinking on a fairly regular basis based on where you are in life, where you are in your FI journey, what's going on. There's so many factors. And to imagine that you could just set something when you were at the very beginning of your journey, whether that's when you're 27 or 47 or 67, it doesn't matter. And then just kind of close your eyes and just let it ride for the remainder of your life. That seems silly. So I think that's what I hope is coming across here. And I think it is coming across very clearly, is you need to update this thinking based on these different considerations. So yeah, Jesse, obviously we've talked about risk and you've dived a little bit into return. And I think this is where it was interesting that that opportunity cost kind of came into play when it came to return. But how would you advise? So that person who's won the game, right? They've hit their FI number. Again, let's just say they're $3 million. So their spending is $120,000 a year. Their FI number is 3 million. They've got that on a screen and they're 100% stocks. Now, at this point, I think it's pretty clear based on the 4% rule of thumb and the calculations that it's not like they can just stick their money in a checking account at that point and get no return. Obviously, nobody's saying
Right.
that. But how would you advise them to think through, like, how to move forward, or really psychologically how to move forward, like what to consider for the return at that point in time?
Yeah, that's a great question. And the numbers are actually helpful here. Because what, it was 3 million in the portfolio and we said $120,000 is spending a year.
Yep,
Great,
exactly.
great, perfect. So my answer, what I'm about to say, is definitely a little bit more on the conservative side of things, maybe a little bit more conservative than the typical FI listener out there. But still, I think it's rational and will make sense. At a very bare minimum, Brad, we need to make sure someone outpaces inflation. Just complete bare minimum. And trust me when I say I hope for myself, it's way better than that. But the spreadsheet that I'd build out for this person would say, well, year one, you need $120,000. And my job is to guarantee with a very high certainty that that money is there for you when you need it. And then I ask myself, well, what kind of investment can I invest their money in over that 12-month timeline to guarantee that the money's there? The answer is not stocks, right? I cannot guarantee that 1 year from now, Brad, the stock market will be higher, equal or higher than it is now. I know it probably will be based on historical precedent, but whatever it is, over a 1 year timeline, the stock market goes up 2/3 of the time
Yep.
or whatever it
Yep.
is. That's not good enough for this kind of analysis, which is why for that first year, that first $120,000 should probably either be in a high yield savings account or a 1 year treasury bond, something like that. And then I go out to year two and year three and year four. And as you go into, call it years 2 through 8, stocks might start to make a little sense towards years 6, 7, and 8. But probably for those first 5 years, we can move out on the lending curve, right? We can get more duration in the bond portfolio. But at least for my approach, I would be hesitant for if someone said they need $120,000 inflation adjusted in 4 years from now, I would be hesitant to put that money in stocks, even though I know there's probably a 90% probability that the stock market is going to be higher in 4 years than it is now. I want to be a little bit conservative, at least at the first run of this analysis. And if I do this continually for this client from now until 30 years from now in this spreadsheet, I'm going to, from the bottom up, build them a portfolio that hopefully the listeners will take my word for it. It's probably going to be something like 20% bonds to cover the first 5 or 6 or 8 years and 80% stocks. Because for year 12, right, you're going to need $120,000 inflation adjusted 12 years from now, Brad. Well, I'm pretty confident that stocks are going to be better off in 12 years than they are today. And I feel pretty good about putting that money into the stock market. And this goes back to the earlier comment where I made where a client comes and they say, oh, my portfolio's down. This is really concerning. Are you guys sure you know what you're doing? I can look at you, Brad, and say, well, Brad, the next 5 years, look at the spreadsheet. All of that spending is in bonds, and bonds aren't down this year, and you're okay. So being able to do that, it is certainly more conservative than the typical, pedal to the metal VTSAX position. But at least for me, it helps people sleep at night a little bit better. And there's a little bit of a mathematical underpinning of why that is.
Yeah, interesting. And right, obviously we can it's hard to go through the math, the underlying math on a
Yeah.
podcast. But I think even just the psychology of it makes sense for certainly a certain percentage of people out there or your clients specifically. And yeah, it's interesting how it all ties into. I know we've had Karsten from Early Retirement Now on so many times, and he has the safe withdrawal rate series, at which last count it is 60 parts, which
Good
is
for him.
crazy and just remarkable. And I mean, essentially like a PhD in safe withdrawal and early retirement. So I think for people who are really looking to dive into the nuance of this framework and also of basically what you just talked about in passing is really those first roughly 5 years are the biggest risk to your early retirement based on market conditions and truly withdrawing money at that point. And that's what Big Earn or Carson goes into in such great detail there. So I would highly advise people check that out. I know it's a big undertaking to read 60 parts. You can get the gist of it certainly from the first maybe 10 or 20 and go from there. But I think, yeah, it would be, in my estimation, and again, it's every person is different because if this person had oversaved, let's say, quote unquote, oversaved, and their spending was 120,000, but they had $10 million, well, the likelihood of them ever running out of money is almost zero. And then we might go and say, you could even have two schools of thought at that point, which is at that point, you could just stay 100% stocks because
Yeah.
it almost doesn't matter. And then you're just wealth maximizing. Or you could equally intelligently say, you've won the game at that point. Let's put it in a high yield savings account getting 5% now, and you ride off into the sunset. So again, this is not financial advice. Let's make that very, very clear. But it's so interesting how, I mean, I just set up kind of an off the wall example, but either of those extremes, I think would be reasonable options to move forward with. But you in that situation would have to decide what works for you. And I think that, again, is what we're trying to get across here.
Mm-hmm. I think in that example, Brad, from my point of view, if someone came to me and they said, I've got 10 million bucks, I spend $100,000 a year. So essentially for listeners, right, they're living off a 1%
1%.
withdrawal rate. And they said, I'm a little worried about X, Y, and Z. So I'm just going to put it all in a savings account. Okay, that's fine. We'll use that as our baseline. But I would pose to that person, I would say, listen, you're going to die. Then let's say you're 60 years old when you're coming to me with this story. You're going to die with $8 million or $7 million or something like that. And then I would ask them, what's your plan with that $8 or $7 million? Are you going to donate it to the local charity? Are you going to give it to your kids? Like, what's your plan? And hopefully they have an answer to that. And maybe the answer is, yep, going to give it to my kids. Great. Well, then I'm going to ask, well, what are your kids' timelines like? Because if you're 60 and you're telling me this story right now, maybe your kids are in their 30s and they're going to be inheriting $4 million each 20 years from now when they're 50. Well, what's it like to be a 50-year-old with $4 million? And you realize they're going to have a really long timeline of their own in front of them. And so I might encourage this person to say, okay, take 5 million of your dollars and put it in savings because that's yours to live on for the rest of your life and you want to feel safe that way. I'm not sure it's good investment advice, but if it makes them feel good for this hypothetical, I'm willing to let that happen. But I would encourage them for the rest of it that they know is going to be handed down to their children and they know is going to have this multi-decade timeline with it. You've got to think about that in a different way than the savings account. you've got to put some more risk on that and get some more return.
Totally agreed. And that's why, yeah, the timeline, which is item 3 here, is so critical. And to understand your own timeline. And it actually, what you just said reminded me of something that Bill Perkins talked about in Die with Zero of, hey, maybe in that case, and again, we're using this one random hypothetical of this crazy situation, but maybe in that case, you give your kids some money in their 30s when they can
Totally.
actually use it,
Totally.
right?
Yeah.
As opposed to their 50s, 60s, 70s when they've probably already won the game at that point. And what was funny was I was actually just having an email conversation with one of our community members, John, and we were talking about Die with Zero. I've talked about Die with Zero so many times, and to me, it's the psychological mindset shift that's in that book that is so critical. And it's funny that we brought up the Safe Withdrawal series because part 60 is basically Big Earn just ripping the financial assumptions in Die with Zero. And again, when I was emailing with this guy, John, I actually said, I didn't even realize there was anything financial in Die with Zero. Like I totally glossed over that. So like whenever I bring up Die with Zero, I am not condoning whatever Perkins was talking about financially. We're not talking about literally dying with $0. We're talking
Right.
about, hey, reorient your spending to different seasons of life. And it's interesting how that all kind of came together, Jesse, here with the Safe Withdrawal series and with this off the wall example. So it was the perfect time to put that little caveat in.
No, all these topics are related though, which is why it is great to have these kind of conversations. And for what it's worth, I also think it's so important. One of the taglines, I mean, this is a shameless self promotion here, but one of the taglines of my blog is "Invest in knowledge." Right? It's Benjamin Franklin's quote: "An investment in knowledge pays the best interest." That's how I got the name "The Best
I
Interest."
love that.
But this idea is right. Read Die with Zero, read Big Earn, listen to Choose FI, and you start to pick and pull different facts from different places, and you start to hear different opinions. And over time, you start to build your own thoughts when it comes to this challenging, semi-mathematical, semi-economical, very personal and psychological topic of personal finance and investing.
Agreed. Let's move on to tax, which is the next
Sure.
one in the Rudy Lou. And now tax can be a very charged subject for some interesting reason. I feel like people get very irrational when it comes to taxes, just generally speaking. There's just something visceral about it. But I'd love to just kind of hand it off to you. And how does tax fit into this acronym?
Yeah. And for what it's worth, probably the risk return and timeline probably are the three most important of the Rudy Lou acronym. But yeah, right, taxation, liquidity, legal concerns, unique scenarios are important too. So taxation, a big one there, and it comes up maybe not as often, but the idea would be, well, what's your tax bracket? What's your marginal tax bracket? That might matter for certain types of investments. A much more common one though is, let's talk about the balance between your traditional accounts, your Roth accounts, and your after tax or taxable brokerage. And we need to think about it from that point of view and say, when someone's writing into the Choose FI Facebook group, we need to ask ourselves, well, is this person better off pumping more and more money into their 401k? Or should they actually think about taking some of their dollars and starting to build up their flexible taxable brokerage? There's a mathematical concern there. There's also just a de-risking concern there. And what I mean by that is the whole taxation investing conversation, the big elephant in the room is that none of us know what tax rates are going to be like in the future. We don't know what our personal tax rates are. Basically, how much are we going to be earning or how much are we going to be pulling on our portfolio? So that's the personal tax rate. And we also don't know what government will do, what tax rates they'll set. And so because of that, the way at least I approach it is I want to go into the future minimizing my tax risk as best I can. And for me, that means trying to strike a balance between traditional accounts, Roth accounts, and taxable accounts. So that in any given year, depending on where the government sets the tax rates, I have the option to say, oh man, tax rates are really high right now based on the current administration. I'm going to pull a little bit more on my Roth. I'm going to keep my income low, and I'm going to realize some capital gains while that income is low. Other years, maybe the government sets tax rates really low. So, okay, I'll pull on my traditional account and I'll pay those lower tax rates. Maybe I'll realize some capital gains while the tax rates are low, et cetera, et cetera. I want to give myself that flexibility. And the whole taxation portion addresses those kinds of concerns.
Yeah, it is interesting, Jesse, how this all kind of, like you said a minute ago, it all builds on itself in so many respects. And I think even the taxes conversation and maybe some of our more advanced financial independence strategies, like a Roth IRA conversion ladder, tax gain harvesting, then the interplay of the ACA subsidies as
Mm-hmm.
well. right? There are all of these interesting intricacies that all tie together. And so it's interesting, Jesse. I just had Sean Mullaney back on the show. So he was on in episode 475, basically talking about ways to access your money before 59 and a half, which is yet another layer to this. And then we actually just answered some questions from the community from that episode, which was really great. And it's fascinating how most of us think that, hey, we want to lower our tax liability in the future. Like that's just like the blanket answer. I want to do everything I can to lower my tax liability. Okay, I mean, that sounds great on the face of it. But then, like I just said a second ago, there are these little extra things to consider of, oh, wow, if your taxable income and tax liability are too low, maybe that might adversely affect you for the ACA and health insurance. So I think some flexibility is what I would generally tell people is, like you just said, having a little bit of maybe I've got some Roth, maybe I have some traditional 401ks, IRAs. I obviously have my regular brokerage account, which we call taxable brokerage, which is just the worst phrase in the world, but we
It
just,
is.
cannot come up with anything better. And just being able to kind of pull on these levers and all of these strategies. I think what's cool about the financial independence community is we're just constantly evolving. And we also realize that the world is constantly evolving. Like you just said, you never know where future tax rates might go. You never know what's going to change. But as long as you stay on top of it and you have flexibility, there are always strategies. And I think there's a very reasonable case for many of us that, again, put aside what you think is right or not right as far as legislative priorities go. That's all beside the point. I think there's a reasonable chance that a lot of us, when we're not working, we don't have current income, that we can get most of our money out of traditional IRAs and 401ks for very little tax, almost zero. And we can also get essentially 100% subsidized health insurance through the ACA. I think that's very viable for most of us in the financial independence community. Again, put aside what you think is right or not right for wealthy people to get that. I understand that's important, but we maximize the rules as we see fit. So again, having that flexibility, like you said, it's really important. And I know I've been going on for a while now, so
No.
I'll let you jump in. But it's amazing how like it all just builds on itself.
It does. It does. And you brought up Sean Mullaney. And when you mentioned Sean's name, I think about myself, I know so much more about the tax system this year than I knew last year, than I knew the year before, the year before. And when I listen to Sean talk, I'm like, oh my gosh, there's so much more to know. I mean, the tax system is very much like a cave system, like one of those underground cave systems. Not that I've ever gone down there because I'm
Spelunky.
petrified. I would never go spelunking. Exactly. But when you read about them, or when I've played some sort of fantasy game with an underground cave system, it's like the deeper you go, the more forks in the road you come to. And you eventually get to this point where you're like, oh my gosh, there were so many permutations and so many pathways, and you don't even know where the bottom is. Like no one's ever even been to the bottom of it all. And all I'm saying is it's a very complex system. There's some nuance involved. There's certainly some better paths than others. Like, Sean might come on here and I think he'd be the first to say, for each individual person, it's kind of like you're mapping the territory all over again. But certainly some paths are better than others. And so I'll just end it with that because the taxation question, it's very important. It can be very complicated. It's definitely something you want to try your best to, it might be hard to find the best path, but you definitely want to be able to find a better path than a bad one.
Yep, agreed. It's funny you were talking about games there. I like that. It made me think of the board game Clank, which we have, which is actually like a subterranean, like different tunnels and such. So my mind went immediately to the Clank board game. So I know people love getting board game recommendations. So that's actually one that I would suggest. I think there's a Clank Legacy game that David Gardner from the Motley Fool really likes. So he's my go-to guy for board game recommendations. So anyway, that was a total random aside. Let's go back to the framework. We're actually getting near the end here. So we got a couple more left. So liquidity. This is something that we've maybe touched on a little bit, but I'd love for you to really talk about that in depth.
Totally. And I think there's a reason a lot of financial planners and tax people love games because really this whole system is like optimizing a game, but we'll save that for another day. Maybe that's a future Choose FI episode for you there. But liquidity, right? We've dipped our toe into liquidity in this conversation. Liquidity is similar, but different Then the timeline question. There's some similarities as we'll go through this, Brad. The idea of liquidity is, do you need to readily access the money? Or is it okay with you if the money is in some way locked up? And a very good common example that many listeners are familiar with would be real estate investing. If you buy a house, rental real estate house, you have to be willing to put up with the fact that you cannot readily access your equity at a moment's notice, right? You've got to list it and put it on the market and find a buyer, et cetera, et cetera. And it might take months. If emergency strikes, it might take months for you to get that money back. Well, with the stock market, we know that we can sell our investment on Fidelity, transfer it to our bank account. It might take 48, 72 hours, and it's right there. When we invest, and depending when we evaluate investments, we need to understand what the liquidity of those investments are. When someone has excess money that they might not need for 8 or 10 plus years, maybe they throw a little bit into a private investment. I don't know. And some of those, I don't have any money in private equity, but I do know that they often require you to lock up your money for 5 or 7 or 10 years. That's part of the deal. They promise outsized returns. Whether those come or not is an entirely different conversation. But, the idea there is, so you can kind of see it's kind of tied up with timeline a little bit, like when do you need the money? But there's also this question of, are you the kind of person who might need it tomorrow? And if that's the case, then liquidity is an important idea for you to consider when you're making an investment decision.
Yep, totally agreed. I think it's, like you said, it's a consideration and it's an important one. It's not at the top of the list, clearly, but it is essential. And yeah, there are a lot of us who invest in real estate, and that's a perfect example. It seems like it would be fairly liquid in the grand scheme of things until there's a major downturn. And then, hey, you might not be able to sell this thing for a couple of years potentially, or at a price approaching something plausible. And that might be fine.
Mm-hmm.
But you have to go into it with eyes wide open. You have to understand, what is my timeline? This is the intersection of timeline and liquidity, right? So just a random example here. But yeah, I mean, I have real estate investments that I bought 15 years ago that are still underwater. I've talked about this so many times here on the podcast. This is like a complete disaster. But I'm now at a point where they're completely paid off and they cost me essentially nothing. So my timeline has changed, and also my risk tolerance on them. When I was paying every month on a mortgage, it was a disaster. And now that they're paid off, okay, well, the timeline and the risk and the liquidity, it all shifts, which is actually pretty fascinating, right?
Yeah. Your investment policy statement, or just your financial plan in general, should be thought of as a living document, right? It changes as your life changes. I think that's one of the fundamental underpinnings of everything we're talking about today, and of financial planning in general, is that it's for your life, and your life changes, and life throws you curveballs. Hopefully things get better in time. Occasionally you'll have a bear market in your own life, and your plan will likely change accordingly. And more on the liquidity topic, Brad, this is getting a little nuanced, but I still think it's important for people to understand there are some investments out here, and I feel pretty comfortable making a blanket statement that different investments than what we've been talking about today. These are more on the exotic side, where when bad things happen in the world or in the markets, there are some investments where the entire market dries up for them, where traders basically say, oh, I'm not touching that until things settle out. There's no way I would buy that right now. It's too risky for me based on the current economic conditions or based on global political conditions, whatever it may be. And if you're the one holding that investment and you need to sell it and no one's buying, that is pure illiquidity. I mean, you are screwed at that point if you need to sell it and no one's buying. And so you will see there were times like during the great financial crisis, if you go back and read about what happened in the markets in 2007, 2008, in that period, there were certain types of investments where people said, like, no way, there's no way I'm going to buy Greek debt right now.
Yeah.
And listeners might be like, well, Greek debt, who cares about Greek debt? The global debt market is significantly bigger than the global equity market, right? We don't play in those pools, but they affect us. They affect the economy as a whole. And so again, this is maybe a little deeper than the typical listener is going to ever face themselves, but it's just worth knowing that certain types of investments, the liquidity can dry up when you most need them to stay liquid. And that's certainly not something that you want.
Yeah. Yeah, that's interesting you bring up the Greek debt, because I forget exactly when that was, but there was at least a year or two in the news where that was a major story, that they thought there was going to be a worldwide contagion if Greece defaulted. And then it just kind of, I haven't heard anything about that in 10 plus years. So it's funny, total aside, but that kind of thing happens. And yeah, I guess that could actually be maybe one or both of these last two here of unique situations and legal, actually, frankly. I'm not 100% sure how legal ties into this framework, but how should we think about these last two? So legal and unique situations.
Yeah, it is good to tie them together because they come up the least often, I would say. I mean, a legal situation might be something like, is there a divorce in place? And is there some sort of policy in place that says even after the divorce has been finalized, there's still some sort of connection, maybe because there's a child, and therefore an investment that you make, you need to consider the fact that, oh, like certain of the proceeds, alimony, like those kind of things. There can be little things like that. Another common one might be depending on what your employment is. Are you allowed to invest in your own company? Are you allowed to invest in your competitors? Little things like that, that it's just worth pausing and just double checking and making sure that what you're about to do is perfectly kosher for you. A unique scenario might be something like someone writes in and they say, oh, my company, they're offering us this great deal, which a lot of companies do. And they'll essentially allow you to buy shares of their own stock at a lower price, at a lower than market price. And then if you want to, you can just turn around and sell them the next day at market price and just collect the 15% profits or whatever like that. But when it comes to someone investing in their own company, well, do you want or need more exposure to your own company? That would be a unique scenario worth considering. So like I said, I think it's almost by definition, these unique scenarios, they're hard to put your finger on. But one of the reasons why it's important to try as best you can to get to know the investor before you make any sort of investment advice, or get to know yourself before you give yourself investment advice. Something I like to think about is that for a lot of DIYers, we are our own financial planners. And we have to try to think of ourselves that way, just to ask yourself, what's unique about my life? And is there anything? I mean, here's another big one that we've run into at work before is we're working with a client who they are a commercial real estate investor. Like that's how they put food on their children's table. And what I mean by they don't invest in like REITs. No, they buy buildings and develop them and rent them out. And so the question then is, well, does this person need any more real estate exposure in their portfolio? Do they need to own the stocks of home builders? Do they need REITs in their portfolio? And the answer is probably not. So again, it's just a unique scenario that comes up when you least expect it, but it's worth understanding on an individual by individual basis.
Yeah, that makes sense. A couple other things jump to mind are maybe people who want to do like the ESG investing, right? Environmental, sustainability, governance, or like don't want to invest in certain companies that they might consider like negative or
Yeah, sin
polluting or
stocks.
vice versa. Right. Like we just had an episode, it was 483, which is actually one of the best episodes we've had, I think, in the whole run. It was on effective giving for the FI community. And this might be a unique situation in your own life in terms of, hey, I want to make considerable charitable donations. And how do I factor that in? Can I donate appreciated stock? What's the interplay with a donor advised fund? So, like all of these potential things that, hey, that might not be relevant for many investors, but it might be really pertinent for you. And I think that's why, again, what we've talked about, Jesse, for this entire hour is this is about you, the investor. And like you said, most of the people listening to this are going to be DIY investors in some way, shape, or form. But even if you're not, even if you have a financial advisor, like this might be something to come in and say, hey, I've got this kind of crazy Rudy Lou thing, but here's what the actual list. And I'd like to talk these things through because they're really important to me.
Yeah. And something you hit on there in that summary, Brad, is the idea that I think for most people listening, start at the top and work your way down. RRTT and the first L, liquidity, definitely worth thinking about. The legal and unique scenarios, they might matter to you, they might not. For what it's worth, maybe an important legal one that I just kind of thought of, Brad, is just the fact that, right, we have legal mandates for when we can touch certain pools of our money, 59 and a half. RMDs start at age 72, 73. So those are some little legal side effects that people should think of. There might be tax limitations that prevent certain assets from being gifted to others, little things like that. Trusts, right? There's a legal loophole. I'm not sure if trusts are spoken about much in the FI community, especially as people start to think about their estate planning. I mean, the whole intersection of estate planning and financial planning and investment management is another one too. But yeah, I mean, for the most part, I think if the average listener starts at the top and starts with risk, return, and timeline, that will do so much good for them and will really lead to better results, not only for yourself, but if you're ever on one of the online forums and offering advice to others, rather than just lobbing, S&P 500 at them, hoping that it's right, because it might be right for them. But try to dig into the RRT up front and understand that person a little bit better. And odds are it'll lead to better FI outcomes.
Nice. Jesse, thank you so much for coming on. I think this is really, really helpful. I think people are going to really enjoy this episode. So we mentioned the Best Interest podcast. You have a blog at bestinterest.blog. And there actually is an article we'll put in the show notes. It's /RRTTLU. And there's a lot more detail on that, certainly. And yeah, where else would you like to send people?
Brad, I think if someone really wants to connect with me, they can find me on LinkedIn or email me, jesse@bestinterest.blog. But going to the blog homepage, bestinterest.blog, I send a really quick weekly newsletter similar to the Choose FI newsletter. That's just, here's my most recent articles, here are my recent podcast episodes, and here's a bunch of stuff from around the internet that I found that I've consumed this week that's really good. Choose FI makes regular appearances there. When I really like one of your episodes, I send it on the newsletter. So I think that's the way that most people, they sign up for that and then they start following along.
Wonderful. All right, Jesse, thanks again for coming on. I really appreciate it.
Thank you, Brad. This was tons of fun.